Oh my god, it has been a hot minute since we've done one of these.
It feels like a calendar year.
We've been hesitating over the record button for the last 10 minutes because we've been thoroughly out of practice.
Yeah.
So I want to open this episode by saying I'm really sorry that we have not been around to do this.
Yeah, it's been... Jesus, have we even done one in this house since we moved?
We definitely have. There is absolutely no excuse for it other than the Cemap changes were announced, which if you caught up to date with these podcast episodes, you'll already know about. That's now been and gone. They've changed. We passed that
done.
deadline.
Finished it.
And then the school holidays hit, and I thought it'll be totally fine. I can balance recording podcasts with having a daughter full-time, 3-year-old. Nope. That did not happen, and then it took a bit of time to get back into the swing of things, but these are effectively backed by popular demand, and I mean that because everybody messaged me on Instagram, and they were like, Charlotte, where have you gone? Where are the podcast episodes? So I've kicked it back into gear. We've remembered how to do this. We might be a little bit rusty for the first 5 minutes or so, but bear with us. And in this comeback topic, we will be covering everything from chapter 23 of your Cemap 2 and 3 textbook. Before I jump into it all though, it's really important that I say in this episode, all of this content from now and in fact this whole series is only relevant really until January 2026 because then the new textbook is out now. Then we get to start again. It's like they keep doing this to us.
Oh my god, we get to start all over again. We get a third go round.
So I will be running into the descriptions of all the previous podcast episodes to be like only relevant up until January. So if you're listening to this and it is past the 16th of January 2026, it might still be helpful, but you might want to double check that there's not been any updated podcast episodes because this could be out of date.
Yeah.
And with that, I guess we should
cue intro music.
Okay, welcome back. It feels like it's all kind of coming back to me
now.
So
slowly.
This topic is all to do with different interest rate options that are available.
Interesting.
And this is weirdly one of the topics that a lot of people struggle with more for Cemap 3.
Okay.
So I've not noticed a huge amount of feedback for Cemap 2 questions on this.
Sure.
But it definitely pays dividends for Cemap 3 because that's when it comes in. And people tend to not do too well with this topic if they've not used most stuff before. So
okay.
I'm going to take this slow and hope that this is an education piece for everybody. We don't have a mortgage.
Nope.
We've actually been in the process of looking for a house. It's stalled slightly, but more on that later. So I'm going to explain this to you in the with the very basic knowledge that you have mortgages. I know you know what a mortgage is.
Big loan.
And I know you know what an interest rate is.
More loan.
Yeah, debt on top of your loan, debt to do with the loan. Exactly. When somebody is shopping for a mortgage, the main job of a mortgage advisor is to find them the most suitable product. We've got that down from previous episodes. We know that. That's
your whole thing.
The issue or the thing that makes a really good mortgage advisor in comparison to an average alright mortgage advisor is finding the right fit of mortgage products because there are so many different products out there.
Yeah.
And there are so many different things that you might not have considered when it comes to patching somebody up with a mortgage.
Okay.
So what we're going to go through in this episode is the difference between something called a standard variable rate product, a discounted rate product, a fixed rate product, which is the one that everybody knows because you're fixed in, your mortgage payments don't change. There's loads of different quirky mortgage products, and it's about finding which one is best dependent on the type of customer or the customer circumstances that you're dealing with.
Got it.
That's why this is good for Cemap 3, because it's like the recommendation thing, which is what the whole of Cemap 3 is about.
Yeah.
Have you ever heard of standard variable rate or SVR?
I mean, outside of the context of the really exciting kitchen chats we have, occasionally on like an advert.
Yeah.
Or like, it'd be like a NatWest advert or something.
Yeah. In the terms and conditions, your home may be repossessed if you do not keep up with these repayments.
Yeah.
Something standard.
Exactly. That's it. But no, outside of that, no.
Cool. The hack for standard variable rate is to remember that you don't really ever give somebody a standard variable rate product as a mortgage advisor, ever.
Oh.
It is the thing that you are automatically switched onto once your product ends.
Okay.
So...
It's like basic bitch mainstream shit.
Exactly. So in the
holding
context...
pattern mortgage.
It's like when your phone contract ends, they keep charging you after that.
Yeah.
And sometimes they charge you more and you're like, what is this? And you realise that it's just because you're out of contract. Effectively, your lender's standard variable rate is when you are out of contract.
Got it.
So it's just once your product has expired, that is what you get switched onto.
Yeah.
So we're looking for a mortgage at the minute, and we're like, do we time for 2 years, 3 years, or 5 years?
Yeah.
At the end of that, we could switch to a different mortgage provider, and we will because it is cheaper. Or we can stay on our standard variable rate product, and it would be like a month-by-month rolling contract.
Got it.
The reason that people don't stay on this one is because it's generally well expensive in comparison to any other product.
Okay, yeah, that makes sense.
So the rate can go up or down. Usually it goes up or down in line with the Bank of England base rate. That doesn't mean it is the same cost as the Bank of England base rate. It just means if the base rate is 1% and your lender's rate is 4%, the base rate goes up 0.5%, your interest rate will go up at least 0.5% because the lender's going to want to recoup that money from you.
Yeah.
So it goes up or down with the markets in general. It tends to be, as I mentioned, quite a lot higher than the average, or well, it's definitely a lot higher than the base rate.
Yeah.
Actually, I'm going to take a step back because we have base rate, and then we have your like the interbank lending rate or your lender's rate.
Okay.
And we did this in Cemap 1, but I don't think we've revisited it for Cemap 2 and 3 at all.
Sure.
So the Bank of England base rate is the one that is the baseline requirement, that's why it's called a base rate, of what has to be charged for interest. So if I was Halifax Bank and I went to get a loan off the Bank of England tomorrow and they charged me 1% interest rate on my loan, why would I not then go and lend the money I've borrowed from them out to my clients at 1%?
Because you make nothing on it.
Because I make nothing on it, right. So lenders' rates are always above the Bank of England base rate. They never go below it.
Got it.
Because
that makes sense.
They want to make their money as well.
Of course.
So if we know that the base rate is 2%, your lender's rate might be 5, 6, 7%. It varies. Your standard variable rate will generally be whatever your lender's rate is at the time.
Yeah.
There are reasons that people will not tie into another product and choose to stay on their lender's standard variable rate, but they tend to be quite niche circumstances. One example is if your house is on the market and you know you're about to sell, you ain't going to remortgage. Because if you remortgage and you don't have what's called a portability option, which is where you can carry the mortgage debt from one house to another, you have to cancel that mortgage product, pay all of your early repayment charges, then take out a new mortgage on the new house.
Yeah.
Early repayment charges are spectacular.
Yeah.
The mortgage product we were looking at, the early repayment charge in year 1 was £23,000.
Yeah.
That's just to come out of the arrangement. It's a cancellation fee. So people don't realise how expensive early repayment charges are.
Yeah.
And if you're a mortgage advisor and you've been dealing with the same client for years and you know that their product has just ended and you ring and go, cool, what are we doing with you next? You should probably ask them if they've got plans to move house in the next 6 months, or if they've got plans to pay off their mortgage in the next 6 months. Maybe they're getting an inheritance, because you would still have to pay the early repayment charges even if you're just settling your mortgage balance.
Okay, so it's applicable basically regardless.
Yeah, so if you win the lottery tomorrow and we'd got that mortgage and you rang the mortgage company and paid it off, they would charge you an extra £20,000 in early repayment charges just because
fucking assholes.
So that is one reason that you might stay on your lender's standard variable rate.
Yeah.
So we've got potentially moving house, potentially settling your mortgage debt for whatever reason, whether it's an inheritance, a lottery win, or you're just switching homes, or whatever it is.
Yeah.
Potential reason number 3 is you've recently gone self-employed. And this is a big one, actually, because a lot of my students, or a lot of people listening to this podcast, might be in employment and considering going self-employed as a mortgage advisor. I had a student on my very last masterclass, which was a couple of weeks ago, who said, I was teaching exactly this, and they said, so my mortgage is due for renewal in the next 5 months. I wanted to give my notice in now, yesterday.
Sure.
Be a mortgage advisor, what implication will that have when I come to remortgage?
Huge.
Massive, yeah. His option, but he was on a 1% fixed rate as well, and now interest rates are 4-5%, yeah. So I was like, well, your options are you stay with your current lender and go onto the standard variable rate. Sometimes lenders, if you've been with them and you've got a good track record with them, they'll do a modified affordability assessment, which is where they don't check your employment and they just switch you onto another product. So that's quite nice and easy. But other than that, because he's not going to have 2 years worth of self-employed income, he's going to struggle to find a mortgage with a high street bank. So most lenders, as long as you squeaky clean with everything, they'll do something just called a product transfer, which is they'll switch you into a different product. They won't check your credit score, they won't check your employment, stuff like that, because you've already proven that you can pay the mortgage.
You can pay them back reliably.
Have to do that though, so some lenders might still do the checks, and that's where it's a bit of a grey area.
Right.
So the advice to him was either wait to quit your job until you've remortgaged, or run the risk of going onto your lender's standard variable rate. And he chose to wait to quit because he wants to make sure he gets the best mortgage interest rate, which I can respect.
I can respect that too, yeah.
That's option number 2. And option number 3 I've just touched on. It's if you have fucking tanked your credit score.
Oh, goody.
So if you imagine you're in a mortgage and you're on a fairly decent rate,
yeah,
you might be in that mortgage for 5 years, that product.
Yeah.
Within that 5-year period of time, you could have gone into an IVA. You can still get a mortgage in an IVA. You're going to find it very difficult, very expensive, but you can still do it. Or you might have just absolutely caned your credit score. In that instance, you do not want to be putting an application through with another lender because they are going to reject you or offer you like 17% interest rate.
Yep.
You might be able to do a product transfer and they skip the affordability assessment, just get straight on. But people with bad credit generally have missed mortgage payments. Not always, but sometimes.
Yeah.
So if it is that they go, oh, we'll do a spot check, and they then realise that you've gone into an IVA, they are not going to offer you anywhere near the interest rate you're likely to be offered.
Yeah.
So the most affordable option at that point would be to stay on the standard variable rate.
Yeah. It's the best of a bad
situation.
Yeah. It's the least worst case.
Exactly. I think I spoke about this before, but to put it into context, when somebody's coming out of an IVA, in my first year out of my IVA, I inquired about a mortgage. Not because I wanted to get a mortgage, but just because I'm a turbo nerd and I wanted to know. 27% was the interest rate I was offered in year 1. In year 2, it dropped, I think, to about 20%.
Oh, kind.
Year 3, about 12%.
Yeah.
Year 4, well, we're in year 4, and what did we get offered? 5%?
I thought it was 6.5.
That was the second one, which we didn't. Anyway, so that's the idea. The more years you are out of your IVA, the lower your interest rate. The lower the
interest rate, because you prove.
Yeah, because your credit score. So those are all of the scenarios that I can think of where somebody would choose to stay on your lender's standard variable rate. And if you want to apply that for Cemap 3, you might get a case study of people that are in financial difficulty, or they're going through a separation,
or they've just gone self-employed.
Yeah,
the scenarios are.
So just be mindful of that. That's standard variable rate, done. Check. We'll do fixed rate next, because everybody knows what that one is.
Okay.
I'm going to say that to you. Maria, do you know what a fixed rate mortgage is?
Blah, 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 blah. Interest rate does not change.
Your interest rate does not change. It does not vary with the markets in general.
For the course of the mortgage.
Exactly. So if you have a client who is very risk averse.
Charlotte.
Yep. And you say to them, how would you feel if you had to lie awake at night and think about the Bank of England's interest rate increasing, and if you know that is going to send you into an early grave like it would me, fix them into something. It is the least risky option because they can budget. They know exactly how much they will pay every single month for the period of the time that they are fixed in.
Yeah.
If you have a case study in Cemap 3 that says Susan is particularly risk averse.
She is fixed, stable, steady, no red flags, no fun stuff, no surprises.
You're not going to give her an interest-only mortgage.
Or put her on Tinder.
Or do that. Exactly. Yeah. You are going to fix her into something. Fixed rate mortgage, safest bet.
Stability.
Every single time.
Predictability.
Exactly. Everything we look for in a man. We know what a fixed rate mortgage is.
Exactly.
Fun fact about a fixed rate mortgage can often come up for people in Cemap 2, I believe, is what is a common feature of a fixed rate mortgage product. And it's generally that they can come with a portability option, which means you can port your mortgage from one house to the other.
That's nice.
So if you have a client that says, I want to live here for the next 2 years, but then I need to move for school catchment areas, which is a whole other subject we're not going to get onto today, you're not going to tie them into a 5-year fixed product unless it comes with a portability option.
Yeah.
So when you're making your product recommendation in Cemap 3, make sure you're looking for the term and whether or not it comes with a portability option.
Yep.
The benefit, obviously, with a fixed rate mortgage is that it's fixed, so it's stable and you know what you're doing. The other benefit is if you tied in, like my Uncle Graham did, at 1% during COVID, and then said, I'll tie in for 10 years, which nobody ever does, but he did because he knew what he was doing.
He knew what he was doing.
His mortgage will be finished in 10 years' time. The benefit is if you tie in when interest rates are low, you are laughing.
Yeah.
The disadvantage is if you tie in now when we're kind of in that uncertain middle ground of are they going to go up, are they going to go down? We don't really know what we're doing. You could end up overpaying. So if mortgage interest rates dropped tomorrow and we had tied into that 5% mortgage, we would have been overpaying by 4% every month and that would have been annoying. But at least you know what worst case is. I want you to think about the fact that lenders never offer an actual genuine discount. So we know what the advantage is with a fixed rate product. If interest rates go up, you are fixed
protected. Yeah.
Lenders always want to make sure they've somehow figured out how to recoup that money just in case. So you will always get application fees. You will very often get product fees. You will definitely get early repayment charges. Sometimes they might charge you for the valuation of the property because there is a potential you could benefit from that product financially. Anything where there is a potential for you to benefit, they will charge you through the nose in some other way, shape or form.
So that they are not footing the bill.
Standard variable rate, not many charges because you're already paying through the nose for the standard variable rate.
Got it.
So that's a fixed rate product. The next one is something called, I've gone all around the houses with this. I've not gone in any way, shape or form the way that I intended to on the notes. A tracker mortgage.
Yep.
I think tracker used to be a chocolate bar. I think that's what Mars bars were called before they were called Mars bars. Somebody's going to correct me.
I thought they were marathons. Or was that a Snickers?
If anybody knows what a tracker bar was, if you could DM me on Instagram and let us know, or send me a WhatsApp, that would be great.
With a picture of it.
Yeah. Do you know what a tracker mortgage is?
Does it track the interest rate?
Oh, it does. So, and this wording is really important because I've seen people fall over with this before.
Take notes unless you're driving, in which case pull over, then take notes.
It tracks a particular interest rate benchmark.
Do we get to know what the benchmark is, or is it like Crystal Maze?
Usually, it's the Bank of England base rate, but it doesn't have to be the Bank of
Of
England
course
base
it
rate.
fucking doesn't. Jesus wept.
So we have the Labor rate, which is the London... Or do we have Sonia now? I can't remember. Oh, no, Sonia. We have the Sonia rate, Sterling Overnight Index Average.
Yep.
Sometimes you can get tracker mortgages that track that.
Ooh.
They don't exist very often. They do kind of exist in some places. The reason that I'm telling you this is because there is definitely a Cemap 2 exam question that is like, which of these statements is true regarding a tracker mortgage? And one of the options is, it always, ever and ever, forever tracks the Bank of England base rate. It's not that one because it's not always, forever and ever. Amen.
So it can track. It's tracking an
interest rate benchmark.
But not necessarily the Bank of England.
Exactly.
So it's like they'll choose which one.
Yeah. So, but generally, and if it says generally, you can go with that one. Generally, it tracks the Bank of England base rate.
Okay.
That doesn't mean it's going to match the Bank of England base rate, though.
It tracks it.
It's just going to track it. So if the Bank of England base rate is 1.5% and you've got 5.5% and it goes up 1%, yours will go up 1% because it's tracking the Bank of England base rate.
Got it.
Does that make sense?
Yes.
Again.
Proportionally.
Yeah. There's going to be things like product fees, application fees, early repayment charges with this one.
All that fun shit.
Sometimes with tracker mortgage products, they can say that you need to take out an additional product with them, like home insurance. Not always, but sometimes I've seen that happen. Might come up in your exam, might not, I'm not sure. Moving on, we've done tracker, we've done discounted rate, I'm getting overexcited. Discounted rate mortgage products.
Okay.
So a discounted rate mortgage product
Yes.
is a genuine discount off the lender's standard variable rate.
Say that again.
It is a discount off the standard variable rate.
Okay.
So if you know that your lender's most expensive product is the standard variable rate product, you could get a discounted rate. It might be a 1% discount. It might be a 2% discount.
Okay.
It just means that it's cheaper than the standard variable rate.
Right.
Which benefits you as a borrower because it's cheaper than the standard variable rate.
Yes.
So because of that, you can expect to pay product fees, application fees, early repayment charges, all of that other stuff.
All the fun shit.
One really fun thing happened. I want to say this was the early 2000s, but this was definitely from like doom scrolling mortgage stuff at a ridiculous time. So, discounted rate product. If we imagine you've got your Bank of England base rate at 1%.
Yeah.
You've got your lender's rate at 3%.
Yeah.
And you have a 1% discounted rate mortgage product. Which means that your rate is currently 2%.
Yeah.
What if the Bank of England's rate dropped to minus 2%? Yeah. Your rate would be minus 1%. What happens if your interest rate is a minus?
They owe you.
The lender pays you money. So that was a really terrible example, but that did actually happen in the early 2000s, where interest, if you had a discounted rate product, standard variable rates dropped so low because
it knocked everything into the minus.
Yeah. Obviously, the Bank of England base rate would never be in the minus, but we were working with such bigger figures that it ended up knocking people's interest rates into the minus, which meant that they were receiving payments from their lenders every month.
I bet that went down like a shit sandwich.
Well, now we have something called an interest rate floor or an interest rate collar.
Okay.
So I want you to literally imagine somebody with like a popped collar on their shirt. And this is going to be important because we're going to move on to talking about a cap and collar mortgage. And you're going to imagine somebody wearing a cap, like a flat cap, with a popped collar. Just the kind of guy I like today.
Yeah.
Okay. His face is the interest rate. So the interest rate can go as low as his collar or as high as the peak of his cap.
Got it.
But cannot go outside of that. Also called an interest rate floor. We have it because people were being paid from their lenders.
That's bullshit.
Yeah. So, just to recap then, discounted rate mortgage product is a discount from the lender's standard variable rate. So it is cheaper. Because it's cheaper and you get a benefit, you're probably going to pay for charges, but they always come with an interest rate floor, just so they don't end up getting shafted as a lender. And that brings us nicely on to our second to last mortgage product type that we're going to talk about, which is it's not a flexible mortgage, my notes are wrong. It is the cap and collar.
Okay.
Cap and collar really simply is you have a ceiling.
And you have a floor.
And you have a floor.
And it shuttles between the two.
Yeah. You would recommend this to somebody who doesn't want to fix in because they think interest rates might drop, but also doesn't want to pay more than a certain amount of money. Actually, this is a really nice product because it's like, okay, this is your upper risk limit, but also if interest rates drop, you will drop to a particular floor as well.
I guess as a mortgage advisor, that would work if you have you have someone who is risk averse, but they're not like you risk averse, or you have a couple where one of them's like, I'm not comfortable, but the other one's like, I think interest rates are going to drop.
Yeah. Exactly that. So it is kind of like the happy middle ground between being completely...
You know the worst case scenario in that the upper limit of your repayments will be this.
Yeah.
And it could be pleasantly lower each month.
And you can say to people, look, you can budget at the maximum amount. Anything that you make on top of that is a benefit.
Yeah, because I guess you could always then overpay if you have an overpayment option.
Exactly. So that's quite nice as well.
Makes sense.
And then the last thing that we're going to talk about for this topic is something called a flexible mortgage. This is really difficult to explain because the textbook talks to us like it's a mortgage product, but it isn't. You can't buy a flexible mortgage. Like, if we had a mortgage advisor, they would not say, I'm going to recommend this flexible mortgage product.
Right.
It's a feature of a mortgage product.
Okay.
So you could have a fixed rate mortgage that was flexible. You could have a discounted rate mortgage that was flexible.
Yeah.
You could have a standard variable rate product that was flexible. The idea is flexible mortgages, or flexibility is a feature of a mortgage.
Got it.
So if you have a mortgage product, be it discounted, tracker, fixed, and it has an overpayment or underpayment facility, a facility to make overpayments up to a certain limit, and where your interest is charged on a daily basis, you have a flexible mortgage product. It might be fixed rate, still flexible.
Right.
It's tricky because it's not a product that you would shop for, but it would be a feature that you would look for in a product to better serve your client.
Got it.
Does
that makes sense. Yeah.
And that was a quick fire overview of this topic. As always, this is
a study guide.
I haven't covered all of them. Either there's offset mortgages, which we haven't even touched on. But we like to keep these at about 25 minutes, which is about where we are now. Really quickly, guys, before you go, it has been a while, and I do apologise for that. Everything has changed. Everything has changed. I don't even know what song that was. I just felt like there were lyrics in there.
I was going to go with We're Going Through Changes.
That one's better.
Because Ozzy's also died since the last time we were here. R.I.P. Ozzy.
Well done. Okay, so everything has changed. If you are studying for Cemap, I can still help, just in a few different ways.
Oh, yeah. We haven't done it since.
Yeah.
Woo!
So the masterclasses have now ended. My last group of students are done. C'est la vie. It was emotional. I now run something different, which has actually proven way more successful and somehow way more popular, which I was really surprised by.
Yeah, you had a big crisis of faith, which
Yeah.
you fuckers don't see. We obviously
Maria sees
live.
the breakdowns
We
on this
see
side.
how we live together. There was a lot of like, oh my god, oh my god, oh my, oh my god, oh my god, oh my god, oh my god, going on. But yeah, no, it's been really good.
Yeah, so the way that this works is if you don't want to take 5 days off work, which I can absolutely respect, but you still want to get qualified for Cemap fairly quickly, I now run a 6-week course. So instead of doing 5 intense days, you do 6 weeks with me. We do 2 hours a week together over Zoom. And then the rest is studying with the e-learning platform. So basically, we will get together on a Tuesday and I will go, Maria, this week I need you to achieve these 5 things, and then come back to me next week and tell me that you've done them. You come back to me the week after, we talk about how that journey was, you tell me that you thought that pensions was really fucking difficult, so we do some more work on pensions. Yeah. I talk to you about things like exam anxiety. I coach you through what to expect on exam day. I give you all the hacks and hints and tips from my previous students that did it the following week. I will hold your hand and drag you through kicking and screaming for 6 weeks. At the end of the 6 weeks, you will sit your exam.
Yeah.
And have a very, very, very good chance of passing first time round.
Yeah.
My last cohort, I think it was 100%. Everybody passed on the first go. So.
Fuck yeah!
That's how it works going forward. So the masterclasses or the 5-day courses or the fast track courses are no more. I now offer the 6-week coaching instead. It's running for Cemap 1 at the minute. The next available cohort is for November. You can sign on to that now. It is only for Cemap 1. And that's because I am currently rebuilding Cemap 2 and 3 for the new changes that have just come into effect.
Got it.
So when this episode airs, the changes will have just taken place, which means anybody that registers for their exam now, so if you haven't paid for it already with Walbrook Institute, you are automatically registered onto the new module. Now, I've almost built the Cemap 1 new module, so that's no drama.
Yeah.
The Cemap 2 and 3 one isn't changing so much, but it's just time for a bit of a refresher. So if you did want the 6-week course, you have to wait till next year for 2 and 3. I'm going to be doing a very, very heavily discounted release for Black Friday, which is coming up before we know it. Or you can just self-study with the e-learning platform, which is still more than enough to get you through. You just have to be motivated to do it. I will link everything below in the show notes. I will even put the link in there for my 60-day CMAP strategy, which is basically 60 days worth of really helpful CMAP emails, and it's all about the stuff that you can't really seem to find anywhere online for free.
Yeah, and it's also it's accountability, isn't it?
Yeah.
Like we had this discussion, it's having someone there that's like, you aren't left to your own devices, because I do not fare well left to my own devices. I will navel gaze and scroll and stare at clouds and just literally do anything but the thing. But if I have someone going, so next week you're going to need to have ticked off these things, I'll be that Charlotte's going to be so disappointed if I haven't done it.
That's it. And I will say, I'm not angry. I'm just disappointed.
I expected better.
And that is all that we have time for this week. Thank you so much for tuning in. It is absolutely fabulous to be back, and I will make a vow to attempt to keep these going every single week, even when
It's school holidays.
it's school holidays. Yeah,
We'll do our best.
And on that note,
Cue outro music.